Imagine for a moment that you are a digital prospector, armed not with a pickaxe, but with rows of whirring, super-powered computers. Your sole mission: to unearth a single specific number, a key that unlocks a treasure chest of 3.125 Bitcoin, worth nearly $250,000 at today's prices. You are in a global race, a silent, invisible war of computational might against millions of other miners just like you. Now imagine the ground beneath you suddenly hardening, the rock becoming denser, the prize moving further and further out of reach, forcing you to push your machines harder, to consume more energy just to stand still. This isn't a scene from a science fiction novel. This is the reality of Bitcoin mining as of just hours ago, when the network underwent its most recent adjustment and the mining difficulty skyrocketed to a staggering, unprecedented all-time high of 155.97 terahashes. Let that number sink in for a moment. 155.97 T. It represents a monumental 6.31% increase in just 2 weeks. A leap that sends a shockwave through the entire crypto ecosystem, from the massive industrial farms in Texas to the individual miners in their basements. This isn't just a statistic. This is a declaration of war on inefficiency, a brutal, algorithmic culling of the weak, and a signal so powerful that it could very well dictate the price of Bitcoin for the rest of the year. But to truly understand the gravity of this moment, to comprehend why this single technical metric is more important than any CEO's statement or any economist's prediction, we need to go on a journey deep into the heart of the blockchain itself, to deconstruct what mining difficulty actually is, and why this new record is a testament to Bitcoin's relentless, unforgiving, and ultimately unbreakable strength. Stick with me until the end of this video, because I'm going to reveal the 3 shocking consequences of this difficulty surge that no one else is talking about. Consequences that will affect your portfolio, the price of your graphics card, and the very future of decentralized money. First, we need to dismantle a common misconception. When people hear mining difficulty, they often think it's a measure of how hard it is to create a new Bitcoin. That's only partially correct. The real, profound truth is that mining difficulty is the Bitcoin network's heartbeat, its primary defense mechanism, and its most powerful governance system, all rolled into one self-adjusting number. Think of it like this. Bitcoin's creator, Satoshi Nakamoto, designed the network to produce a new block of transactions approximately every 10 minutes. This 10-minute interval is sacred. It's the rhythm that keeps the network stable, secure, and predictable. But what happens if 1 million new miners suddenly plug in their machines? The collective computational power, known as the hash rate, would explode. With all that extra muscle, those blocks would start getting solved every 9 minutes, then 8, then 7. The network would become unstable, inflationary, and chaotic. This is where the magic happens. Every 2016 blocks, which roughly translates to every 2 weeks, the Bitcoin protocol performs a diagnostic check. It looks at the time it took to mine the previous 2016 blocks. If it took less than 2 weeks, the network intelligently, automatically, and ruthlessly increases the mining difficulty. If it took more than 2 weeks, it lowers the difficulty. It's a perfect self-correcting thermostat for security. The recent adjustment to 155.97 T is the network screaming one thing at the top of its lungs. More power has come online in the last 2 weeks than at any point in its entire 15-year history. The hash rate, the total measure of all computers competing to solve those blocks, has smashed through previous ceilings, creating a digital gold rush of unprecedented scale. This isn't just growth. This is hypergrowth. This is a global arms race for computational supremacy that is now entering a new, more intense, and more expensive phase. The barrier to entry has just been raised, dramatically and decisively. But where is all this power coming from? The answer is a complex tapestry of technological innovation, geopolitical shifts, and pure financial greed that is reshaping the world's energy landscape. A significant portion of this surge is directly attributable to the arrival of a new generation of mining hardware, machines so powerful and so efficient that they are making previous models obsolete overnight. We're talking about application-specific integrated circuits, or ASICs, from companies like Bitmain and MicroBT that are pushing the boundaries of physics. The latest models, like the S21 or the WhatsMiner M60 series, are achieving efficiencies of under 20 joules per terahash. To put that in perspective, just 2 years ago, the industry standard was around 30-35 joules per terahash. This is a monumental leap in performance. It means that for the same amount of electricity, these new machines can compute almost twice as many guesses, vastly increasing their odds of winning that 3.125 Bitcoin reward. This creates a vicious cycle. As newer, more efficient machines come online, they push the difficulty up, which in turn makes the older machines unprofitable to run, forcing miners to either upgrade or get left behind. It's a brutal technological treadmill, and it just sped up by 6.31%. This upgrade cycle is concentrated in regions with access to cheap, reliable capital and even cheaper electricity, which leads us to the second major driver, the great migration of mining power. After China's blanket ban on crypto mining in 2021, the industry fragmented and relocated, with the United States, particularly Texas, emerging as a new global hub. But other players have entered the stage with ferocious ambition. Countries like Kazakhstan, Russia, and even Ethiopia are seeing massive investments in mining infrastructure, often attracted by subsidized energy costs. This geographic diversification is a net positive for the network's resilience, but it also means that the competitive landscape is more globalized than ever. When a mining farm in Siberia plugs in 10,000 new ASICs, it impacts the profitability of a smaller operation in Nebraska. This global competition, fueled by cheap energy and new hardware, is the primary engine behind this relentless climb in difficulty. It's a testament to the fact that despite price volatility, regulatory pressure, and constant media FUD, fear, uncertainty, and doubt, the foundational security of the Bitcoin network, its hash rate, is not just holding strong, it's achieving escape velocity. So the machines are getting smarter and the players are getting bigger, but this leads us to the multi-billion-dollar question that every single person watching this video, whether you're a miner or just a Bitcoin holder, needs answered. What does this soaring difficulty actually mean for the market, for security, and for the future of the network? The immediate, gut-level reaction from many is to see this as a bearish signal, a harbinger of increased selling pressure. The logic seems sound on the surface. Miners have to cover their costs, primarily the astronomical electricity bills required to keep their rigs humming. As the difficulty goes up, the profit margin for every machine gets squeezed. Less efficient miners, those running older S17 or S19J models, are now suddenly thrust into the red, their daily revenue no longer covering their operational expenses. When this happens, these miners are forced to make a difficult choice. They can either shut down their machines, which is a painful capitulation, or they can do what the market fears most. They can sell the Bitcoin they are mining the instant they receive it, or even dip into their treasured reserves to pay the bills. This, in theory, creates a steady, relentless trickle of sell-side pressure on the exchanges. It's a compelling narrative, and there is certainly some truth to it, especially for operators on the edge of profitability. However, this simplistic view completely ignores the profound and ultimately more powerful bullish undercurrents that this record difficulty creates. Let's flip the script. This record-breaking difficulty is, first and foremost, the most potent vote of confidence the market could possibly receive. It represents a colossal, multi-billion-dollar bet on the long-term health of Bitcoin by the very people who know it best, the miners. Think about it. Building a large-scale mining operation isn't a whim. It's a monumental capital expenditure. You're investing millions upfront in hardware, securing a facility, negotiating power contracts, and hiring technicians. This isn't a trade you can exit in 5 minutes. This is a long-term infrastructure play. The miners who are deploying this new, expensive hardware and driving the difficulty to these insane heights are not doing so because they believe the price is going to crash tomorrow. They are making a calculated bet that Bitcoin will be significantly more valuable in the future, making today's investment worthwhile. They are signaling with their wallets and their watts that they believe in the long-term appreciation of the asset so strongly that they are willing to operate on razor-thin margins today for the promise of riches tomorrow. This is institutional conviction made manifest in code and silicon. Furthermore, this difficulty surge acts as a powerful fortifier of the network's security, making a malicious attack not just improbable, but practically impossible from an economic standpoint. To even attempt a 51% attack, where a single entity gains control of the majority of the network's hash rate to double spend coins or halt transactions, an adversary would now need to amass a computing force capable of outputting over 155 terahashes per second. The cost to acquire, power, and cool such an army of machines is astronomical, likely running into the tens of billions of dollars. Even if a nation-state or a corporation could muster such resources, the moment they launch their attack, the value of Bitcoin would likely plummet, rendering their entire expensive endeavor worthless. They would have spent a fortune to destroy the very asset they were trying to manipulate. This record difficulty, therefore, is a moat around the castle, a moat so deep and so wide that it makes an assault a financial suicide mission. It solidifies Bitcoin's position as the most secure, decentralized computing network in the world, a fact that is not lost on large institutional investors, sovereign wealth funds, and corporations who are looking for a safe haven asset outside the traditional financial system. This brings us to the most critical and often overlooked dynamic: the impending supply shock. The Bitcoin halving, an event coded into its DNA that cuts the block reward in half, is now just months away. We are on the precipice of the most brutal supply constriction in Bitcoin's history. In April 2024, the block reward will drop from 6.25 BTC to 3.125 BTC. After the next halving, it will be just 1.5625 BTC. This is a fundamental, unchangeable law of Bitcoin's economics. While the difficulty is a measure of the competition to acquire new Bitcoin, the halving is a hard cap on the supply of new Bitcoin. We are now witnessing a historic pincer movement. On one side, the difficulty is skyrocketing, making it harder and more expensive to produce each new coin. On the other side, the halving is about to slam the door on the flow of new coins, cutting the daily issuance from 900 BTC to just 450 BTC. This is a recipe for a historic supply and demand imbalance. The miners who survive this current difficulty spike are the strongest, most efficient, and most well-capitalized operators. They are the ones who will be left standing after the halving, and they will have no incentive to sell their drastically reduced rewards at low prices. They will hoard, they will accumulate, and they will wait for the market price to reflect the new brutal reality of Bitcoin production. The convergence of these two forces, record-high difficulty and an imminent halving, creates a powder keg of bullish potential that the mainstream financial media is completely missing. They see the energy consumption and shake their heads, but they fail to see the unbreakable economic engine being forged in the fires of this intense competition. This isn't just a number on a screen. It is the sound of a financial system being reinforced brick by cryptographic brick, and it is growing louder by the minute. But to see this only through the lens of price and profit is to miss the deeper, more revolutionary story unfolding in the background. A story of energy, innovation, and a fundamental re-architecting of our global power grid. The most common and potent criticism leveled against Bitcoin, a criticism that gains volume with every new difficulty record, is its energy consumption. Detractors point to the sheer computational power, the terahashes upon terahashes, and decry it as a wasteful environmental catastrophe. A digital beast consuming enough electricity to power entire countries for no tangible good. This narrative is not just simplistic. It is dangerously outdated and fails to grasp the profound economic alchemy that Bitcoin mining is performing on the energy sector. The truth is, Bitcoin mining is unique among all major industries in one critical aspect. It is completely location agnostic. A factory needs to be near its supply chain and its workforce. A data center needs to be near population centers to minimize latency. A Bitcoin miner needs only two things: an internet connection and electricity. This simple, profound fact transforms miners from mere consumers of energy into the world's most flexible and opportunistic buyers of power, creating a powerful new economic tool that is already beginning to solve some of the energy sector's most intractable problems. Let's start with the problem of flared natural gas. In oil fields across the globe, from the Permian Basin in Texas to remote sites in Siberia, natural gas is a byproduct of oil extraction. Often there's no pipeline infrastructure to transport this gas to market, so oil companies are forced to do one of two things. They can vent it directly into the atmosphere, which is pure methane, a greenhouse gas over 80 times more potent than CO2 over a 20-year period. Or they can flare it, burning it off, which converts the methane to CO2, but is still a massive waste of a potential resource and a significant source of emissions. This flaring wastes enough energy to power entire nations. Enter the Bitcoin miner. With a containerized mining operation, a company can set up a data center right at the wellhead, plug into that stranded flared gas, and convert it into economic value. They are monetizing waste, turning a pollution problem into a profitable global security service for the Bitcoin network. This isn't a theoretical future. This is happening right now, and the record-high difficulty is a direct result of the efficiency and profitability of these operations coming online. They are taking energy that was literally being set on fire and throwing it into the competitive arena, pushing the difficulty up while simultaneously reducing emissions. It's a win-win that fundamentally redefines the environmental argument. Then we have the issue of grid stability and renewable energy. The great challenge with wind and solar power is their intermittency. The sun doesn't always shine, and the wind doesn't always blow. This creates massive peaks and troughs in energy production. During periods of excess production, a sunny, windy day in California, the grid can become overloaded, and the price of electricity can actually go negative. Power providers sometimes have to pay other grids to take the excess electricity to prevent damage. Or worse, they have to curtail generation, essentially wasting the clean, renewable energy they've built their infrastructure to capture. This is where Bitcoin miners come in as the ultimate grid partners. A mining facility can be turned on and off in seconds, something no other large-scale industrial load can do. A miner can enter into a contract with a wind or solar farm to act as a load of last resort. When there is excess power on the grid that no one else needs, the miner powers up, soaking up that surplus, monetizing the renewable energy that would otherwise be wasted, and providing a crucial revenue stream for the green energy provider. When demand on the grid spikes, say during a heat wave when everyone turns on their air conditioning, the miner can power down completely within minutes, freeing up that precious electricity for essential services. This turns a Bitcoin mining operation into a dynamic, responsive battery for the grid. It provides a financial incentive to build more renewable energy infrastructure because it guarantees a buyer for power during times of low demand. This symbiotic relationship is already being pioneered in places like Texas, where miners are being integrated into the ERCOT grid as a strategic, flexible tool to prevent blackouts and stabilize the network. The record 155.97 T difficulty is, in part, a reflection of this new era of energy arbitrage. It's proof that miners are seeking out the cheapest and often the most stranded and problematic power sources on the planet and putting them to work. This is not a story of energy waste. It is a story of energy efficiency and financialization on a global scale. Bitcoin mining is creating a global spot market for electricity, incentivizing the use of energy that would otherwise be wasted. and providing the economic impetus for a more resilient, robust, and surprisingly, a greener energy grid. The very metric that critics point to as proof of its profligacy is, in fact, the clearest evidence of its transformative power. The hash rate is not just a security metric. It is a global vacuum cleaner for inefficient energy, and it's just getting started. So we stand here at this singular moment in Bitcoin's history, looking at a difficulty chart that is scaling a vertical cliff, understanding now that this number is so much more than a technical metric. It is a complex signal of unprecedented security, a catalyst for a global energy revolution, and a brutal economic filter ensuring only the most efficient survive. But this brings us to the ultimate personal question. What does this mean for you, the individual? Whether you're a seasoned crypto veteran or someone just now peering into this fascinating, chaotic world. The era of casual hobbyist mining is unequivocally, undeniably over. The dream of plugging a few graphics cards into a rig in your garage and hoping to stumble upon a Bitcoin is now a nostalgic relic of a bygone era, finally extinguished by this latest jump to 155.97 T. The capital requirements, the technical expertise needed for managing industrial-scale operations, and the sheer cost of power have created a moat that individual players simply cannot cross. This is not a cause for despair, but a call for a strategic pivot. The democratization of Bitcoin is no longer happening at the mining level. It is happening at the ownership level. Your role in this ecosystem is not to compete with the gigawatt farms in Texas, but to understand the powerful forces they unleash and to position yourself accordingly. This record difficulty is a flashing neon sign pointing towards one of the most fundamental laws of economics. When something becomes exponentially harder and more expensive to produce, and its supply is simultaneously being programmatically choked off by a halving, its value is being structurally engineered for appreciation. Think of Bitcoin as a digital commodity like oil or gold, but with a crucial difference. Its production rate is perfectly inelastic. You can't ramp up production to meet demand. In fact, the system is designed to do the opposite. When demand surges and price potentially rises, it incentivizes more miners to join the fray, which pushes the difficulty up, which makes each new coin even more expensive to produce, thereby establishing a higher and higher foundational production cost. This rising difficulty is effectively manufacturing a higher and higher floor price. Miners, especially the publicly traded ones, have shareholders to answer to and debts to service. They cannot operate at a loss indefinitely. The collective operational break-even point for the entire network is being ratcheted upwards with every adjustment. This doesn't mean the price can't fall below that point in a bear market. It can and it has, but it creates a powerful gravitational pull, a baseline of value underpinned by sheer physical reality. Energy consumed, hardware depreciated, and capital deployed. This is the silent, relentless engine that drives Bitcoin's long-term value proposition, completely independent of the hype cycles on social media or the whims of celebrity influencers. The narrative is shifting from a speculative digital token to a fundamental store of value with a verifiably scarce and provably difficult-to-produce supply. This is what institutions are beginning to understand. They see the difficulty metric not as an obscure technicality, but as a real-time auditable measure of the network's security and the intrinsic cost of production. They see the convergence of this soaring difficulty with the approaching halving as a historic arbitrage opportunity on the laws of mathematics themselves. The final and perhaps most profound implication of this ever-increasing difficulty is what it signifies for the long-term endurance of the Bitcoin network. Each tick upwards is another brick laid in an impregnable fortress. It represents a deeper and deeper commitment from a more diverse and robust global industry. It is a signal that the network is so valuable, so trusted, and so resilient that players are willing to engage in the most competitive and capital-intensive industrial race on Earth just for the privilege of participating in its security. This creates a powerful feedback loop of security begetting trust, begetting value, begetting more security. It is the ultimate proof of work, not just in the cryptographic sense, but in the human and capital sense. The world is literally working harder than ever to secure this network, and in doing so, they are building an asset that is increasingly immune to failure, attack, or obsolescence. The journey of Bitcoin is no longer a fringe experiment. It is a mainstream macroeconomic event, and the mining difficulty is its most honest and uncompromising heartbeat. Now, I want to hear from you. This is a complex and fast-moving topic, and its implications are vast. What is your biggest takeaway from this record-breaking difficulty adjustment? Do you see it as a bullish signal for the long term, or are you concerned about the centralization of mining power? How do you think the upcoming halving will interact with this new difficulty landscape? Drop your thoughts in the comments below. I read every single one, and the discussion we have there is just as valuable as this video. If this deep dive clarified the often misunderstood world of Bitcoin mining for you, if it connected the dots between energy, economics, and security, then do me a huge favor, smash that like button, and subscribe to the channel if you haven't already. We are just getting started. We've decoded the what and the why of this difficulty surge, but in my next video, we're going to get tactical. I'm going to break down the 3 specific, actionable strategies that you can implement right now to position your portfolio for the massive structural shifts that this difficulty and the impending halving will create. You do not want to miss it. Turn on those notifications so you're the first to know when it drops. Thank you for watching.